Hi, welcome to this quick podcast where I'm going to look at our provisions. This is mainly really for the students that I teach anyway, more related to AS and A2. What international accounting say? Well, the first thing is the international accounting standard that talks about provisions is IAS 37, and that's called provisions, contingent assets, and contingent liabilities. I'm not going to worry at all about contingent assets because the specification that I teach, we don't need to deal with them. But what I am going to concern with is a provision which is a liability of uncertain amount or timing. And it's a liability as a present obligation as a result of past events, which will result in an outflow of resources. So what we're talking about, for example, is if there's an industrial accident and there's clearly going to be some kind of claim against the business, then we know that the business is going to be found, or almost certainly going to be found, to be liable for the accident, and therefore there might be a significant outflow when it goes to court of payments to people who've been affected by this event. They need to be recorded as a liability, or when we're looking at things like depreciation, a reduction in asset values in the final accounts. So although it hasn't, the actual outflow, the money hasn't happened yet, we have to make a judgment if it's more likely than not this is going to occur. And if it is going to occur, then we have to record this in the final accounts. I've got contingent liability. This is an obligation for payment which may exist depending on future events, or obligation of payment is improbable, or the amount is completely unknowable. And these are things that are probably not going to happen, but may happen. And these would go in as a note to the accounts, not as a payment or a liability. So what we mean by a note for the accounts, if you haven't done limited companies, is it's a record, if you like, written down underneath the final accounts, and it says that an event might occur in the future which might cause significant harm to the business. Okay, the ones we need to calculate, and most of these, three of these, are actually then calculated and reduced from an asset, or provision for bad debts, provision for unrealised profits, provision for depreciation, and particularly if you've done any limited company accounting, you'd also be aware that companies calculate what they believe the tax is going to be that gets paid to local government and national government, and they record those as a decrease in profit in the income statement. But there are many others. I just want to show you one here that's in a company called Premier Foods from the UK. Premier Foods has an issue where its pension fund is smaller than it should be for the anticipated amount of money that they've got to give to people in the future when they retire from the business, or indeed people that have stopped working for the business but are going to retire at some point. If you look here at Premier Foods' latest set of accounts, they've got this recorded in here as a liability of 464.7, and that's £1 million. So it's a significant amount of money. And these cropped up in the UK particularly, but I think in other countries, because there was a period in the 1990s where share prices increased quite dramatically, and companies then stopped paying money into their pension funds because they believed that these increases would go on for the long term. And then when there was a crash in 1999, people or firms then found that they actually didn't have enough money in these funds to pay out the liabilities. Other common provisions that you might see in companies' accounts, you've got things like environmental cleanup. There was a big case with BP in the 2000s. They released their accounting information in March every year, and not long after the accounts came out, BP had a large oil rig in Mexico called the Deepwater Horizon which exploded basically and polluted large parts of the Gulf of Mexico, and they had to create significant provisions in their next set of accounts for all the costs of cleaning up a large area of land. Covered pensions already. If a company is planning on restructuring the business and it's going to result in significant redundancies in the short term, they would go in as a provision and therefore as a liability. Legal action, again, that links to something like BP with the Deepwater Horizon disaster. Warranty or recall of products, so something that you may well all have seen on the news from time to time is when there's been a fault in a particular car and car manufacturers have to recall the cars and fix a problem. Similar problem with Boeing with their recent aircrafts, where they've had to recall aircraft and do significant work on them. That needs to go in as a provision under liability. And something that was relevant in the UK at times has also been where companies have signed contracts and those contracts have proved to be loss-making. And if you know that you're in a contract for maybe 5 years and you're going to be losing 10 million a year on the contract, then you would need to put in a provision for this loss. Okay, that pretty much covers off provisions. It's about all you need to know at A level. Okay, thank you for taking your time to listen. I'll speak to you